Welcome to This Explainer. Today, we're diving into a genuinely transformative concept from our source material. We are going to break down how you can drastically accelerate your wealth building journey, and we're going to do it without taking on unreasonable, keep-you-up-at-night risks. If standard passive investment strategies make the finish line feel literally decades away, well, the structured approach we're analyzing today offers a fascinating, high-speed alternative. 1 crore. Now, turning a modest $5,000 monthly investment into this massive milestone doesn't necessarily have to take 20 or 30 years of waiting around. According to the source material, it's entirely possible to hit that mark in just 10 years. The crazy part? It only takes about 5 extra minutes of effort a day to tweak how and when your money actually enters the market. Okay, let's dive into this level-up strategy. We're going to build from the ground up, covering the mutual fund fee trap. Level 1, switching to ETFs. Choosing your risk profile. Level 2, buying the dip. Level 3, pledging for margin. And finally, compounding your extra returns.
Let's kick things off with Section 1, the mutual fund fee trap.
So, before we can even talk about speeding up your wealth creation, the source emphasizes that we absolutely have to stop the wealth leaks. And the first massive leak, the expense ratio. This is essentially a hidden recurring fee, often hovering between 1% and 2.5% that mutual funds deduct straight from your capital. To put that into perspective, let's say you invest 1 lakh rupiah. If your fund has a 2% expense ratio, the asset management company instantly skims off 2,000 rupiah before your money even has a chance to enter the market. Your actual working capital drops to 98,000 rupiah on day 1. Over years and years of compounding, that seemingly tiny percentage eats a massive hole in your final wealth. And then there's another major trap, the exit load. Think of this as a hidden toll booth. It's basically a penalty fee, typically between 1% and 4%, charged if you pull your mutual fund investment before a specific time frame. Because, life happens. Let's say you need to buy a property or you suddenly need to fund an emergency and you need access to your own money early. The mutual fund slaps you with this exit load, penalizing you heavily just for getting to your own capital.
Moving right along to Level 1, switching to ETFs.
To completely bypass these traps, the strategy suggests a quick upgrade, moving to an exchange-traded fund, or ETF. An ETF trades exactly like a regular stock, but it holds a perfectly diversified portfolio. And this brilliantly illustrates the difference. Just look at the comparison. While mutual funds are dragging you down with up to 2% expense ratios and 1 to 4% exit loads, an ETF tracking a major index like the Nifty 50 can have an expense ratio as shockingly low as 0.05%, plus 0 exit load, literally none. Shifting your money here immediately keeps so much more of your capital fully invested and working for you.
Next up, choosing your risk profile.
Now, because not all ETFs are created equal, the source strongly recommends aligning your choice with your specific stage in life. Take a look at this age-based risk matrix and find your demographic. If you're under 30, your earning potential is rising and you've got decades ahead of you. You can totally afford a high-risk profile, focusing on aggressive ETFs like small cap or the tech-heavy NASDAQ. In fact, the source material highlights that in phenomenal years, these aggressive sectors have chased 36% to even 68% returns. Now, if you're between 30 and 60, maybe with a family and mortgages, you drop to a moderate risk profile, focusing on steady, balanced indexes like the Nifty 50. And if you're 60 plus, you focus on low-risk debt or safe options to protect that hard-earned capital. The whole trick is just knowing your zone.
All right, let's step it up to Level 2, buying the dip.
This is where we introduce that promised extra 5 minutes a day of effort. Instead of just blindly throwing money in on the first of every month like a traditional SIP, check out this smart daily 5-minute routine. Step 1. Set a simple alarm on your phone for 3:15 p.m. That's about 15 minutes before the market closes. Step 2. Open your demat account and check if the overall market index, like the Nifty, is in the red, meaning it's negative for the day. Step 3. Let's say your monthly investment goal is $20,000. Divide that by roughly 20 trading days, and you get $1,000 a day. You invest that $1,000 only if the market is down. So what if the market is positive for 3 straight days? You do absolutely nothing. You just save your cash. Then, on the 4th day, if the market is finally negative, boom, you invest the accumulated $4,000 all at once.
Now, the absolutely crucial point here is why we do this. By intentionally buying only on the red days, you consistently lower your average purchase cost. It makes sense, right? Markets don't go up in a perfectly straight line. They zigzag. By catching those dips, you generate what the pros call alpha. This incredibly simple 5-minute daily habit can push a standard 12% market return up to a really impressive 15% or even 20% plus over time.
And now for the heavy hitter, level 3, pledging for margin. This right here is considered the absolute powerhouse of the strategy. And don't worry, the source reassures us that this doesn't mean taking out dangerous personal loans. Rather, it's about efficiently leveraging the assets you've already securely accumulated. The mechanical steps are super straightforward. Right inside your demat account, you select an option to pledge your existing ETF shares. For a tiny nominal fee, usually around Rs20 plus GST per script, you are essentially using your portfolio as collateral. By doing this, you're unlocking all this hidden liquidity inside your long-term portfolio. You receive trading margin without having to sell a single one of your precious long-term ETF shares. It's a real game changer.
Yeah, when you pledge, you're run into a term called a haircut. Now, not that kind. This is just a 10% to 20% safety buffer that the broker retains when providing you with interest-free trading capital against those ETFs. Let's break down the math really quick. Say you've built up a 10 lakh rupees ETF portfolio. The broker applies a 10% haircut, meaning they will provide you with 9 lakh rupees, or maybe 8 lakhs if it's a 20% haircut, of interest-free buying power right into your trading account. Think about that. You are being given hundreds of thousands of rupees of capital to trade with, and you aren't paying a single dime in interest. But here is the catch, and the source material stresses this heavily. This margin is absolutely not for gambling. It is for strictly managed algorithmic intraday trading. The golden rules here are non-negotiable. You set a strict 1% profit target and an absolutely unbreakable 1% maximum loss limit. And to make sure you stick to it, you let software algorithms automatically execute these trades. Emotion is entirely removed from the equation. If you follow this strictly, aiming for just a tiny 1% win on that capital for merely 3 successful days out of the entire month, it stacks an astonishing additional 36% annual gain onto your total portfolio. That is wild! Finally, let's tie it all together in compounding your extra returns.
Now, what's really interesting about this slide is how the math just completely explodes when you stack these strategies. A standard mutual fund SIP trickles along at maybe 12% over 10 years. It's slow, it's steady, but it's bogged down by fees. Now switch to ETFs and spend just 5 minutes a day buying the dips, and suddenly you push that to 20%. But when you combine those dips with the automated margin trading strategy, you are pushing 40% plus annual returns. It absolutely crushes the traditional timeline, catapulting that $5,000 a month into the 1 crore stratosphere in just a single decade.
So, as we wrap up this explainer, I want to leave you with this thought. What if just 5 extra minutes a day is literally all that stands between you and decades of financial freedom? By scrubbing out those hidden fees, intelligently timing your purchases, and securely leveraging your assets, the source strongly suggests you can evolve from a passive observer into the active architect of your wealth. Thanks so much for joining me for this explainer, and happy learning.